We're analyzing Abbott Laboratories stock ticker ABT to see if this great business is on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Abbott. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Abbott for your stock portfolio. Before we get into these valuable metrics, let's understand Abbott's stock performance. Right now, Abbott trades for $106.35 per share. Year to date, their stock price is down 3%. In the last 5 years, Abbott's compounding at 11% annually. In the last 10 years, they're compounding at 12% annually. Going back prior to the global financial crisis, it looks like Abbott's stock price is compounding at just under 5% annually. However, this is misleading. Abbott spun off their pharmaceutical business, AbbVie, in January of 2013. Both Abbott and AbbVie have performed very well since then. Abbott is a dividend king. They've grown their dividends for each of the last 51 years. Right now, Abbott pays a 1.84% dividend yield. Their average dividend yield throughout this time is in addition to their returns in their stock price. Abbott trades $9 below their 52-week high. They're up more than $10 from their 52-week low. Just about 0.5% of their shares are sold short. Abbott is a huge business. They have a $185 billion market cap. But the burning question, what is it about Abbott's business that's given them this insane dividend history? Abbott manufactures and markets medical devices, adult and pediatric nutritional products, diagnostic equipment and testing kits, and branded generic drugs. Products include pacemakers, implantable cardioverter defibrillators, neuromodulation devices, coronary stents, catheters, infant formula, nutritional liquids for adults, molecular diagnostic platforms, and point-of-care diagnostic equipment. Abbott gets about 60% of sales from outside of the United States. It was founded in 1888 and is headquartered in Chicago, Illinois. Now with this understanding, let's get into the numbers. Metric number 1, we want Abbott's average return on capital in the last 5 years to be above 14%. A typical business earns about 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based off the quality of the business. Abbott's returns have increased in all 5 of these years. They earned just under 16% returns on capital in their last fiscal year. When we average this out, however, Abbott's earning about 11.8% returns on capital in a given year. While that's solidly above average, that's a couple percentage points below the benchmark we're looking for. This is an X on metric number 1 for Abbott. Metric number 2, we're looking for growth to go with their above average returns. This metric's all or nothing. Their revenues, net incomes, and free cash flows need to have grown in their last 5 years for this to be a check. We'll also include their numbers up until today when we're calculating this growth. During this time, Abbott's grown their revenues by 36%. Their earnings have doubled, and their free cash flows have grown by 39%. This is growth across the board for Abbott. This is our first check of the day coming in on metric number 2. Metric number 3, we're looking at Abbott from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We learned in our last metric that their earnings or their net incomes have doubled. At the same time, Abbott's very slightly bought back some shares. They've repurchased just under 1% of shares. With these small share buybacks and this earnings growth, this has led to earnings per share growth for Abbott. Another check here on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. A similar story here. Abbott's grown their free cash flows, and with these small share buybacks, this is a check on metric number 4. To recap where we stand currently, Abbott has 3 checks and only 1 X through 4 metrics. Can they keep this good performance going? But there's still one vital piece missing. You might think nailing growth and having good returns is the key, but we haven't touched on the one thing that I believe sets Abbott apart, which is having these without using a lot of debt. Metric number 5, we want Abbott's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 years. In this time, Abbott's reduced their net debt position, they've increased their cash, and they've reduced their long-term debt. Abbott ended last year with $7.8 billion of net debt. Right now, they have $7.5 billion. In the last 5 years, Abbott's generated $31.5 billion worth of free cash flow. That's a massive amount compared to the debt they're using in their business. This is a huge check. Abbott could pay off all of their net debt with about 1 year's worth of their current free cash flows. Compared to the debt they're using in their business, Abbott generates a ton of free cash flow. This is a good sign for the financial health of the business. Before we get into our valuation methods, it's time for our bonus. As our bonus, we're looking at Abbott's dividend profile. Abbott is a dividend king. They've grown their dividends for each of the last 51 years. Right now, they also pay a 1.84% dividend yield. To have sustainable dividend payouts, we want Abbott to support their dividends using their free cash flows. That's been the case in all 5 of these years. Abbott has not only grown their dividends per share, they've also grown their free cash flows per share. Their free cash flows have grown faster than their dividend, meaning they've decreased their dividend payout ratio, potentially making their dividend even more sustainable. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. Abbott supported their dividends throughout, and they support their dividends now. This is a check on our bonus. The big metric of them all, metric number 6, we want Abbott's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Abbott. Right now, Abbott has just under a $193 billion enterprise value. This accounts for their market cap and their net debt position. It looks at Abbott similar to it being a private company. In the last 5 years, we learned Abbott generated $31.5 billion of free cash flow, meaning they produce about $6.3 billion in an average year. When that's divided by their nearly $193 billion enterprise value, we get about a 3.3% average free cash flow to enterprise value yield. On a current basis, Abbott produced $6.8 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get about a 3.5% current free cash flow to enterprise value yield. Both of those are coming in just below the yield of the 10-year treasury. They're down from the risk premium we're looking for, meaning on metric number 6, this is an X for Abbott. Don't just throw this business out. We still need to estimate Abbott's fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Abbott, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Abbott's been a predictable business in its past. We're starting with an average of their last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Abbott. Assuming they grow their 3-year free cash flows at just over 8% annually for the next decade. Then in the following decade, assuming that this growth rate is cut in half, if we add in Abbott's tangible book value, which gives an estimate of their net worth, if we want a 15% rate of return, which is what Warren Buffett looks for from his investments, at today's valuations, if these are the same in 20 years, an estimate of Abbott's fair value per share is around $46. That's less than half of their current stock price. Keep in mind some key points. Abbott's been predictable in its past. That's not a guarantee for the company into the future. Also, this discount rate is an estimate of total returns to shareholders based on their free cash flows. It would include both the increase in Abbott's stock price and their dividend yield. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Abbott, but we have to address something first. We've covered the numbers, but the qualitative factors may be even more important for Abbott. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, Abbott's sale of its established pharma business in developed markets to Mylan and its acquisition of CFR and Veropharm have put the branded generics business in a strong position to benefit from growing demand in emerging markets. Number 2, early results from an investigative clinical trial on the Tendyne transcatheter mitral valve were favorable. If the pivotal trial results are favorable, this could give a boost to Abbott's structural heart unit. Number 3, Abbott has been investing in structural heart products and recently entered the left atrial appendage closure market. But we'd be remiss if we didn't cover the negatives as well. Looking at the factors supporting a short thesis, number 1, falling global birth rates in the wake of the pandemic would offer challenging conditions to Abbott's nutritional segment. This could saddle nutritionals with an unfavorable secular trend. Number 2, Abbott faces a crowded field in the molecular diagnostics arena, where it must go head-to-head against market leader Roche, along with energetic competitors like QIAGEN and Hologic. Number 3, clinical data on drug-eluting stents and alternative therapies have put a crimp in percutaneous coronary procedures, as medical therapy and coronary bypass have gained favor. There you have it for a balanced perspective of some of Abbott's qualitative factors. Now it's time to give our rating. In analyzing Abbott Laboratories, stock ticker ABT, Abbott has a lot of signs pointing toward it being a good business. They earn above average returns on capital, just slightly below our benchmark. They've grown consistently, they generate a lot of cash flow, and they use small amounts of debt in their business. Abbott's easily supported a growing dividend. It seems their track record as a dividend king is likely to continue. It's worth reiterating this analysis is not financial advice. Compared to the yield of the 10-year treasury, Abbott's free cash flow to enterprise value yields don't look attractive. When we performed our discounted cash flow analysis, if today's multiples are the same 20 years from now, you believe those assumptions and you want a 15% rate of return, an estimate of Abbott's fair value per share is only around $46. Abbott was last at those levels back in May of 2017, so you need to be patient. Looking at all the factors of our analysis, Abbott looks like a modest candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Abbott, and let me know what business to look at next in the comments below. Check out the video I just made on Abbott's spinoff AbbV. Thanks for learning about Abbott with me, and have a great day.